What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday, everybody. I hope you guys had a lovely weekend and have a productive week ahead of you. As we discussed yesterday, in a concerning development for officials pursuing a strict zero cases policy, over the weekend, Beijing reported the capital city's first case of Omicron. This coming less than a week after the neighboring port city of Tianjin discovered China's first official local case of the highly transmissible variant. In Beijing, the authorities have sealed off areas linked to infected people and launched massive virus testing covering millions of residents, but epidemiologists warn that Omicron is much more difficult to track and control than previous variants. Even state media is concerned that the situation will get worse before it gets better, with the Global Times writing Sunday evening, quote, "Beijing may be subject to more stringent measures such as citywide testing if more sporadic flare-ups within the city are reported." End quote. Indeed, Huang Yanzhong, senior fellow for global health at the US Council on Foreign Relations, observed over the weekend, quote, "With few people in China infected by Delta, Omicron is likely to become a dominant strain in a short time after it enters the country if it can't be effectively controlled, triggering large-scale outbreaks." End quote. In a sign of what may be to come for the capital, a few hours from Beijing is the city of Tianjin, which has been fighting its own outbreak for over a week now. New official local cases rise every day, with Sunday, yesterday, seeing almost 100 official new cases being confirmed. Writing this morning, Chinese financial media outlet Caixin Media argued, quote, 2 years into the pandemic, China has developed a playbook consisting of virus screening, contact tracing, and targeted quarantine that have proved effective in containing several domestic flare-ups. But the defensive line is becoming less solid in the face of Omicron because many infected people don't have obvious symptoms and can't be detected in a timely manner. End quote. Patients recorded in the latest Omicron outbreaks have so far shown mild symptoms in the mainland, according to official reports at least. This is similar to what has been observed internationally. However, the serious concern in China is economic and political. If zero tolerance is pursued and cases continue to grow, the economic impact alone, which could include huge lockdowns of industrial centers, could be devastating. And it is not just the north that is seeing cases. The southern Chinese city of Shenzhen reported its first locally transmitted case of the Omicron variant of COVID-19 on yesterday. The city reported no cases for Saturday. Shanghai so far has not confirmed any new local cases for 48 hours, but we are also seeing new cases in Guangxi for the first time. Okay, next up, today, Monday, this morning, the National Bureau of Statistics in Beijing published the official data for those in North America for GDP growth in China for the fourth quarter of last year. Based on official data, China's gross domestic product grew at its slowest pace in 18 months in the fourth quarter. This is unsurprising considering Beijing is grappling with sporadic COVID outbreaks, a power shortage, and the housing crisis. Official data claims that GDP expanded 4% year-on-year in the fourth quarter, exceeding economists' forecasts, but slower than the 4.9% growth in the third quarter, 7.9% in the second quarter, and 18.3% in the fourth quarter. This means that China's economy officially grew by 8.1% in 2021, reaching $18 trillion, clearing the quote-unquote above 6% target China set for itself. Indeed, state media is pointing out that 8.1% is the fastest growth China has seen in 10 years. However, let's keep in mind that in 2020, which is what 2021's performance is being compared against, Chinese growth saw a historic collapse. So it's best to look at average rates over the last 2 years, and that average annual growth over the last 2 years is a more modest 5.1%, slow by modern People's Republic of China standards. More concerning to those who believe China needs to rebalance its economy towards consumption, over the last 2 years, retail sales grew by an average of 3.9% versus 5.1% for GDP and 6.1% for industrial output, implying a reversal in 2021 of just over 60% of the 2020 decline in the consumption share of GDP. That is to say, household consumption has still not recovered since before the pandemic. Indeed, with the release of the data, the head of the National Bureau of Statistics conceded that, quote, the domestic economy is under the triple pressure of demand contractions, supply shock, and weakening expectations. End quote. Some global analysts are more pessimistic than others for 2022. For example, last week, US investment bank Goldman Sachs slashed its 2020 forecast for Chinese economic growth from 4.8% to 4.3%. Now, some may simply roll their eyes at this official data and dismiss it as completely unreliable, and indeed, massaging of economic numbers, particularly at the local level, is well documented. But at the very least, we can see one major trend here, and that is prolonged economic slowdown. If we want to make comparisons, the International Monetary Fund estimates that the United States economy grew at 6% last year. There is also the question of how useful it is to compare GDP growth in China with other countries. Over the weekend, China finance expert at China's most prestigious university, Peking University's Guanghua School of Management, Professor Michael Pettis, made the following observation, quote, this set of tweets from a Chinese think tank about what steady GDP growth means in China's political and economic context shows just how different the concept of GDP growth in China is from other countries, and why it is meaningless to compare them. Among other things, they discuss a proposed shift from high-speed growth to high-quality growth, as if these were two different things. They are not. If GDP growth has any meaning at all, it is as a proxy for the real economic value of goods and services generated by the economy, in which case there can be no difference at all between high-quality growth and high-speed growth. A country's GDP growth is supposed simply to represent the increased ability of workers and businesses in that country to generate economic value. If Chinese businesses and workers are producing a more valuable set of goods and services, then GDP should grow. Period. End quote. Professor Pettis then turns to the issue of politically set growth rates and quotes the following from the Chinese think tank. So this is what the think tank had expressed in the document. Quote, to ensure the absolute gap between China's and the US economy not widen, as China's GDP is 70% that of the United States, China's economic growth needs to outpace the US by 50%. End quote. On this point, Professor Pettis observes, quote, for them, in other words, one purpose of GDP growth seems to be to prevent the reported gap between the United States and Chinese GDPs from growing. In which case, they say, if US GDP grows by 2.4%, China must make its GDP grow by 3.6%. But if China can choose its GDP growth, why settle for 3.6%? Why not choose 4.8%? Or better yet, 10%? If GDP growth is a proxy for the economy's productive capacity, and they can control it, then they should be growing GDP as fast as they can. So why don't they? Clearly, it's because they don't think recorded GDP growth in China is a proxy for real growth in the country's productive capacity. They want a symbolically meaningful GDP growth rate, but nothing higher. End quote. Now, while we're on the economy, also today, the People's Bank of China, China's central bank, cut the rate on its one-year policy loans by 10 basis points to 2.85%, the first reduction since April of 2020, during the worst days of the Wuhan lockdown. The central bank injected 200 billion RMB, approximately $31.5 billion US dollars, of medium-term cash into the financial system too. The consensus is that the move is intended to accelerate the pace of policy easing and to encourage credit supply, and suggests concerns for China's economy. Okay, next up, along with official economic numbers, The National Bureau of Statistics this morning also published official population data, and whether accurate or not, the numbers were not good. According to the data, mainland China's population increased by less than 500,000 last year, with the number of births dropping for the 5th consecutive year in 2021. The overall population increased by about 480,000 people. This means that China's birth rate dropped to a record low 7.52 per 1,000 people in 2021. Experts have warned that China's already rapidly aging population is about to begin declining too. And some argue that birth numbers have been exaggerated for years now, and that China's population has already begun shrinking at an alarming rate. Now, last up, Evergrande. Quickly, if you're enjoying the episode, don't forget to hit the like button. It's the only way this video can be shown to new people. And if you're watching this for the first time, you're getting some value from the episode, maybe consider subscribing, hit that bell notification, and you'll have the most up-to-date analysis when I release these every day. Okay, let's move on. This morning, Monday morning, in Hong Kong, Bloomberg News reports that concerns about hidden debt at Logan Group, a developer we started following with increased interest in recent weeks, is, quote, fueling heavy selling across both junk and investment-grade dollar bonds from Chinese developers, according to credit traders. End quote. High-yield notes fell as much as 3 cents on the dollar. Logan Group's dollar note due 2023 sank 10.8 cents to 66.1 cents in morning trading, leading declines among Chinese developers. We remember from Friday, the developer denied rumors that it had privately placed debt after market concerns it wouldn't meet its obligations. Logan Group is not a huge player. It's China's 20th largest developer by contracted sales, but Country Garden is. The Cayman Islands Incorporated company. Country Garden is China's largest developer by sales revenue, with over 720 billion RMB, approximately 113 billion US dollars, in revenue in 2021, almost double the revenue of Evergrande. Market concerns over risk smashed Country Garden's shares and bonds last week, and concerns remain this week. After hits to Shimal Group in recent months, Country Garden is seen as one of the last so-called healthy bets in the Chinese property development sector. If Country Garden goes, then the entire sector is likely rotten to the core. In a research note today, analysts at Bloomberg argue that the company is viewed as a bellwether for contagion risk, as unprecedented levels of stress in the offshore credit market threaten to drag good credits down with the bad. With more than 3,000 housing projects located in almost every province in China, Country Garden's financial health has immense economic and social consequences. If the firm starts showing signs of stress, it will severely damage already fragile investor and home buyer confidence, posing threats to China's entire housing sector, economy, and even social stability. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.